The world went to war. Missiles over the Middle East. The Strait of Hormuz blocked. Oil up 40% in 3 weeks. And gold fell. If you don't understand why, you're going to miss the biggest opportunity of the next 12 months. Here's what actually happened. On February 28th, the U.S. and Israel launched nearly 900 strikes on Iran in 12 hours. Khamenei was killed, Iranian air defenses were destroyed, the Strait of Hormuz was effectively shut down, cutting off 20% of the world's oil supply. Gold spiked to $5,589 an ounce, an all-time record. And then it dropped more than 6%. Every beginner thinks war equals gold up. Simple logic. But there's one thing that kills gold faster than any war: a strong dollar and rising real yields at the same time. When the war started, global investors did what they always do. They ran to the safest asset on the planet. And that's not gold. That's the US dollar. Treasuries surged, real yields climbed. The Fed, watching energy inflation explode, signaled it wouldn't cut rates anytime soon. Gold pays no dividend. Gold pays no interest. When real yields rise, the cost of holding gold goes up. That's why it fell. Not because gold is weak, because the dollar got stronger faster. Now here's what the smart money is actually doing. JPMorgan kept their target at $6,300 per ounce by end of 2026. UBS raised their target to $6,200, with an extreme scenario of $7,200 if the conflict deepens further. Why are they still bullish after the drop? Because they're looking at the full picture. Central banks, China, India, Turkey, Russia, are buying physical gold at record volumes. Not dollars, gold. That's not speculation, that's state policy. U.S. fiscal deficits are unsustainable. America is adding over $1 trillion to its debt every 100 days. At some point, that erodes confidence in the dollar, and when confidence in the dollar breaks, gold explodes. And here's the one that most people are missing right now. Energy inflation is about to bleed into everything. Oil at $112 a barrel doesn't stay contained. It enters transportation costs, production costs, food prices. In 6 to 9 months, you'll see it in CPI numbers. When the market realizes inflation isn't going away, the rate cut narrative dies, and gold decouples from the dollar and rises on its own. That cycle is already in motion. Now let me give you my honest read on what comes next. I see 3 scenarios. Scenario 1, fast resolution. Diplomacy kicks in. Hormuz reopens within 60 days. Oil falls back toward $80. The Fed gets room to cut in the second half of the year. Gold corrects to $4,400 to $4,600 short term, but still ends the year above $5,000 because the structural case doesn't change. I give this about 25% probability. Scenario 2, prolonged war, no nuclear escalation. This is my base case, 50% probability. The conflict drags on for 6 to 12 months. Oil stays between $100 and $130 a barrel. U.S. inflation climbs to 5 or 6%. The Fed is trapped. It can't raise rates without killing the economy, and it can't cut rates without making inflation worse. Gold goes to $6,000 to $6,500 by end of 2026. This is exactly what JPMorgan and UBS are pricing in. Scenario 3, full regional escalation, 25% probability. Iran activates all proxies simultaneously. Saudi Aramco infrastructure gets hit. Oil goes above $150. We get stagflation, high inflation, economic contraction, the 1970s, but worse. In that scenario, gold goes well above $7,000. You don't want to be in equities. You want physical gold, gold ETFs, and cash. Here's my personal view. I think we are in scenario 2, moving slowly towards scenario 3. The assassination of Ali Lajarani, Iran's most pragmatic political figure, tells me Israel is deliberately closing diplomatic windows. That's not a sign of a short war, that's a sign of a war designed to run. The $5,000 level is the key zone to watch right now. That's where institutional buyers have order sitting. If gold closes above $5,000 for 2 consecutive days on strong volume, the correction is over, and the next target is $5,500, then $6,000. If it breaks below $4,800 with conviction, it tests $4,400 to $4,600 first, which I would treat as a gift, not a warning. Gold is not just a metal, it's the world's confidence thermometer. And right now, wars, debt, inflation, central banks buying gold quietly, confidence is draining fast. We are not at the beginning of this move. We are in the middle of it. If this made sense to you, share it with someone who needs to hear it, and drop a comment below. Which scenario do you think plays out? I read every single one. XAU Decoded.